Welcome to the Dividend Talk podcast, episode 228, 2024 Performance Review. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit EuropeanDGI.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Just want to start by saying Happy New Year to all our listeners and Happy New Year to you, European DJ. We've made it to our 5th calendar year on the podcast, 2025. Let's be having you. How are you doing?
I'm very well, and Happy New Year to you also, Derek. 5 years, amazing, right? It's really amazing. 5th season, 5th calendar year. But let's complete the full 5 years.
Yes.
In May or June this year. And let's at least toast on it on 27 January when we will have our dividend day in the Netherlands.
Yes. I know we put it up on Facebook. We are going to Netherlands, Utrecht, if I pronounce that correctly.
Yes.
So
people can still sign up, right, to join. And we have a dozen of people that already did that. We'll send the calendar invite anytime soon, but if you still want to join and you're listening, just let us know. It's not only Dutch people that will be there. There's someone coming over from England, I believe someone from Germany. Utrecht is quite central also in the Netherlands. You can easily fly to Amsterdam and take the train literally from the airport straight away into the city of Utrecht, or you take the Autobahn from Germany, whatever works best.
Yeah, whatever's easier. I'm looking forward to that, I have to say.
And we have someone from Belgium, by the way. Let's not forget.
Yeah, quite close by. But let's jump straight into the news of the week, shall we? And you know, Christmas time, Ireland, everyone likes to drink a lot. And we got some news over in the US, and there was some Surgeon General Vivek Murthy, and he's saying that alcohol is not good for you. And I think most of us probably know this already, but I think he alluded to that there's a risk of 7 different types of cancers. And what he's looking for now is what we have on tobacco packages that we put onto alcohol. So you have these warning signs and labels and so on. And as a result of that, we have had most of those stocks actually dip 3 or 4%. And it probably led to a question. We got a question from Rodrigo, and he says, he has 2 questions, but that's the second one later. But he's asking us, is alcohol doomed to be a business like tobacco? And I suppose the question's off the back of this report or this finding by the surgeon.
Well, you know, if that would be the case, I mean, welcome to the high yielders. I would see it as an opportunity. I mean, Diageo was trading for 2% for a very long time. Why not have them at 7 or 8% like British American Tobacco? You know, you get them at no dividend tax. So in Poland, you can nicely have such stocks then in your tax-free retirement accounts, IKS. So yeah, no. Some part of me actually hopes this.
I mean, you get Pernod Ricard now for 4.5% dividend yield.
So it's starting to get there.
Which is quite nice. I don't know about Heineken. I haven't looked at Heineken, but they don't have a history of not maintaining. But out of out of all the stocks, I think Pernod Ricard or Diageo is obviously iconic. It's
Ambra, the
number one.
Polish Ambra is also around 21 zloty now or something like that.
Yeah.
It's really also again at the multi-year low somewhere.
Yeah, so quite interesting. I would say I think it has a bit to go before it's like tobacco. If I'm honest, it's a long way to go.
But the question I have to you,
Go for it.
because this is pub talk, I'm noticing in my surroundings that people are less and less drinking alcohol, like and more out of health conscious. That they say like, no, I wanna be healthy, I wanna be fit, sporting, and it wasn't too uncommon for some of those people that are saying that now to just pour away half liter of vodka on an evening, right? Here, like the vodka shots, and I'm still the same. So at times we can call this the vodcast then, right? But it's very interesting. It's a good thing to be honest, right? Because I'm not such a drinker, but from time to time I enjoy it.
Yeah.
But I do know, some people are very sensitive to this, and this can be very addictive and ruining families. So people become much more health conscious, I think is good. And if that comes at the cost of holdings in our portfolio, so be it.
Yeah. I think what I see in Ireland is definitely the younger generation are not drinking definitely as much as what our generation and generations before would have done. They're generally drinking a lot less, but COVID also had an impact. And the culture here was, the pubs used to be always packed all the time, any day of the week. And you were here a couple of years ago, and that was not the case.
No.
COVID has had a big impact on that type of culture. And I think it's been actually a negative impact, because what I've noticed now is that people are drinking a lot more at home. So they're going to the office and drinking at home, and it doesn't highlight how much they're drinking. And I do know from talking to people that some people might have 1 or 2 beers a day. Not major, it's not big, it's not major, but if you had to go to the pub, you would not do that. So I think it's changed the culture that way. Personally, I don't like drinking at home. I like to go out. The whole point of it is going out and meeting people and whatever. So it's 90% it would be going out. I would drink at home. I'd never actually drink in my own house. It's normally if I go to parties or something.
We did the podcast.
But that was a special occasion. But I would never just sit down and watch TV and have a drink. It's just
no, same here.
So I think the culture's changed big time for that. But I think younger people definitely have caught on and more health conscious. I look at my own 2 kids; they won't even eat sugar anymore, so let alone touch a drop of alcohol. So it's good. There's a lot of education around it. Not so good if you're a shareholder in these companies, though, because we need consumers. We need consumers. So we'll
but they consume other stuff again. They have no issues sitting probably the whole day on TikTok.
Yes, TikTok and
talking about addictions, right?
There's always some voice or something that.
There was a really nice episode of the Diary of a CEO. This guy with his podcast was about dopamine, and I was talking a lot about the influence of dopamine on addictions. Very interesting. If people are interested in this topic, I would definitely recommend listening to it, because it explains a lot about why actually also if people are more conscious about this stuff may not want to drink at all, maybe at times.
Makes sense. But look, I think this could create some opportunities. I know that market was under pressure anyway. Diageo, Pernod Ricard rely a lot on China as well, which there was pressures. So this will add some pressure and the share price will drop. But I think it's a sector that I'm watching keenly, because there's some opportunities there.
Yeah, definitely. And I'm also wondering, I haven't made up my mind yet if this is something to stay that we were just discussing, what we both observe. And of course, our surroundings is not, I would say, it, a sign for how the whole world thinks about it, of course.
Exactly.
That's important to notice. But I remember very vividly when McDonald's was suddenly out of favor. Yeah, who wanted to poison their kids with a hamburger from McDonald's? Now, if I go to McDonald's, everything is packed. And McDonald's did it really wisely at the time. First of all, I think they got a new CEO at the time. I'm not 100% sure. Who got ousted again, I think, for some, was it dating within the company?
Keep
it positively. But what they did at the time is they did a very clever marketing campaign targeting more the parents as well by those exclusive burgers. Remember those that when they got introduced, well, it took them only a few months and McDonald's was fully packed again everywhere here, the ones that I know. So sometimes those may be kind of trends for a while, maybe influenced on social media, whatever it may be. But if a company does it smart, then this can be quickly reversed again.
Yeah, exactly. And look, we're living in developed countries and some good times at the moment compared to other parts of the world. And emerging markets is obviously key for most of these companies because that's where they make most of their money. So let's see. I don't think it's dead. I don't think it's doomed to be like tobacco just yet. It could possibly be. I could be wrong, but I just don't see it at the moment.
Hey, but then we get the high yield stocks in our portfolio like that with reliable income streams.
4.5% is high enough. It's not bad.
Yeah, well, that's what is it? Is that like a cheap beer? 4.5%?
Yeah, cheap beer.
Yeah. What is wine? 10%? I really don't know.
I don't know. Is wine between 8 and 12? Maybe could be.
Okay, so we want more like the wine levels of dividends.
So why not just go to whiskey and get 47%?
I will be buying hand over fist, but watch out for the hangover then.
yeah, exactly. Watch out for the hangover and loss of memory. Nice one. Yeah, I think it's a sector to watch. I think that's the gist of what we're saying. So 2024 performance review. I think you might give more of a quarterly update because I know you have your annual report coming out. Last year you got a lot of requests. You never got around to it, so I'm happy. I've seen a preview of it, so I know it's definitely coming out. So I'm happy to see the annual report. So I'll start. I'll start with my 2024 kind of review. So I had two goals at the start here. I don't know if I share them on the podcast or not. Probably share them with you. But the first one was dividend income was to be nearly 5,500 after tax. So after tax is the key there. And portfolio to be above 100,000. Those were my two goals at the start of the year. Newsletter I announced on the podcast back in September, just start of September, I hit the 100K mark. So we know that one's ticked off. That was nice to achieve. It was good. And actually it's about 10% growth since then. So I'm nearly at 110K, which is crazy in that short amount of time to me. But look, we've had a bit of a bull market as well. We've had some tailwinds behind that. My savings rate, I calculated this out over the last 2 days, is 36.4%. So I've invested 36.4% of my income. It would have been a little bit higher, but there's some outstanding loans and we pay extra on our mortgage on top of that. So if I was to include that, it would be a little bit higher. But 36,
but that's still amazing. More than a third of your paycheck that you're receiving. Come on.
Yeah, which is quite good. And what I forgot about is I actually had a trading 212 PI that I completely forgot about, and there's money going into that there's like €100 a week going into that automatically, and I just forgot. I didn't even look at it. I didn't even know it was there. So that was a nice surprise, I have to say.
Did it perform well?
It's on track, which is good, and there's a couple of €1,000 in there which I wasn't expecting.
Wow!
So it was quite nice.
Hey, and this 36.4%, can we go a little bit deeper into that? Because I find that very interesting. What is the contributor to this? Why I'm saying oftentimes we are able to increase, because I know you didn't have these rates, right, before.
Yeah.
So is it due to having a flat cost level and increasing salary? Is that really what is increasing your savings rate? Because that was how I got to the levels where I'm now, because I've been also at the 30-something% range, but then every time taking the salary hikes, keeping cost under control really allowed me to go to the 50%.
Yeah, costs do. So my main costs remain kind of the same. The big expenditures last year was I went on a couple of big holidays. So Vegas was obviously a big outlay. And then I went on a family holiday and a couple of other trips in between. So that was a big outlay. So that bit is variable. But my income has increased substantially over the last 3 or 4 years. I knew Vegas was coming, so I was putting away I was putting away for that, so it wouldn't have a big impact. So it's pretty much cost control, because other than holidays, my spending is pretty much nearly the same, and then big salary increases. So if I was to take away the holidays, that would obviously jump quite high as well. And I don't think this year will be as busy as last year, because I had a couple of big holidays last year. So that should jump up to about 40%, hopefully.
Wow.
Which would be
Well done. Well done. Now, this is really impressive, because people sometimes underestimate how much the saving rates matter more than your portfolio performance itself, right? People can get caught up on whether the stock went 5% down in a year. But if you've been able to save up 5% more in a year, in the, let's say, first 10 years of the accumulation phase, believe me, that's probably more impactful. Yes, which is also good to remember, that it's okay to make some mistakes here and there. You don't need to take your inspiration from social media, where people are saying, I went 40% up over the year, because they put everything into, I don't know, NVIDIA or something like that. Yeah. You can make mistakes. If you keep your savings rate under control, take that as a learning, because at that moment in time, those matter more. Later on, hopefully after you implement those learnings that you have, and make less mistakes over time, because that's later on the compounding will do the heavy lifting of your portfolio, and that's when you want to be in a situation that you're really like kind of mastering the game.
Yeah, you want to be kind of happy with your portfolio, and you'll see that in some of my companies. I'll go through my additions and sales. 6-7 years into this, I'm not without mistakes, and I think you have to learn as that. And I got asked a question yesterday by my nephew, who wants to start investing now. He wants to start investing in crypto. So I mean, the first conversation I had with him is, okay, is this short term or long term? I don't know. So I mean, I knew where it was going. It was going to be short term, but I was trying to just tease out to him, okay, look, you're young, only 18, you can make some mistakes. I have no problem with you investing some in crypto, because that's your generation. That's where the world is. Take 50% and start looking at ETFs or stocks or something, and try and build both of them out. Have your volatile, high growth, and have something behind you. But he's young enough to learn, and I think it's really important what you said. Make the mistakes at the beginning when you're not investing as much money. If you're putting up 200K straight off the bat, you probably don't want to make a mistake. But if you're investing monthly, it's a different story. But in total, I invested in 29 companies this year. I have a portfolio of 38. 36 of them are dividend related. 2 of them are from options that I still hold. I think they're 96% in the loss. It was Solo, Electrica, and Wish, if you remember. So they're in my portfolio 2 years. I can't even sell them. They're that low. So they make up 38. I added 14 new positions. I won't name them all, but some of them I've added has been Brookfield Asset Management, Evolution, which was a small position, Greg's in the UK, which is probably more high growth, obviously dividend as well, Iberdrola, Munch on Machine, and some investment trusts. So Solar NESF is a couple, and there's some more, but they're just to give you a flavor of what I've been adding. So you can see there's a mixture of growth, there's a mixture of high yield, and there's a mixture of steady yield in between them. I sold a couple of, I would say, low conviction stocks at the time. Unilever, I spoke about on the show with the growth. I know they've increased the dividend since. You're welcome. I sold Beatrice, BASF, NNN Retail, which is a real estate investment trust. I really only sold them because I had Realty Income and Agree Realty. And
yeah, I just want to ask, because NNN is quite well known as a
it is. I had three of them. I didn't need to have 3 in my portfolio, so I just took it out and put it into Agree.
Well, Realty. You know that I've got Realty Income, Agree Realty, Cibus, Defama.
Yeah, but they're so
different markets, different geographies. I realize
different markets. Yeah. Whereas mine were all in America, so I didn't need 3. I only got rid of NN because my lowest conviction out of the 3 at the time. I had done more of a deep dive on Realty Income, Agree Realty for the premium, and I just kind of read the annual reports, but didn't dive enough into them, so just sold them based on that. I also sold CME Group, which I know is a good company. They pay special dividends consistently. You can almost count that they are not special anymore because they do it every year. But my conviction wasn't there in terms of the growth. And I did the London Stock Exchange last week as a deep dive, as you know, and my conviction around them would be much, much greater than CME Group based on tables. So look, they were just low conviction for me, so I sold them and moved into more higher conviction holdings from me. So, excuse me. So my goal was to make nearly 5,500 after tax, and you can see it. The listeners can't see it, but I made 5,600 after tax, which is amazing. I didn't think I'd reach that. I kind of set a goal that I didn't think I'd reach, but I did invest a lot more this year than I did over last year, so that kind of helped. My dividend income increased 24.56% over last year, which is quite high. But you can see, look, the trend is definitely going down. 2020 it was 166%, 79%, 50%, and now I'm down to 24%. So that gets smaller and smaller, but you can see the increases in monetary values is going up. I don't do what you do. I haven't calculated how much is organic and how much is not. I could probably do a quick calculation, but I don't have that. And then the last thing I tracked, thanks to Snowball Analytics, that I occasionally use is broker fees. And I paid €270 in broker fees this year, which, considering the amount I've bought and sold, is not too bad, in fairness. It could have been
but
a lot
still,
worse.
now you understand why those low-cost commission brokers, low-cost brokers, still earn a lot on even a boring dividend growth investor.
Yeah, 270. So I don't know how many.
Yeah, that's quite a lot, right? If you 250 per client, I mean,
clients.
Twice as much as our premium subscription goes to brokers' fees.
Yeah, which is interesting when you put it that way. But it's like it doesn't seem like a lot. I think it's It's actually is a lot. It's 0.35%.
That's a lot, because if your yield is 5%, then your real yield is 4.65%.
Yeah. So it takes out, but it could be a lot worse. If I was to look at some of the Irish brokers, they charge a lot more money than our low cost. But I thought it was an interesting thing to track.
And then we have Alan, who buys like hundreds of companies per year, lives in Sweden, and because of how the banks operates, he pays probably like €2 or €3 per year on fees. And he gets all the dividends, dividend tax reclaimed automatically by the banks. I mean, for me, Sweden sounds like a Valhalla for dividend growth investors.
Free investments and tax back sounds like a dream. We can only hope that happens over here. We can only hope.
Yeah, we need some more Vikings in the European Parliament.
I mean, Ireland was taken over by the Vikings. I don't know why we got rid of them. We should have kept them.
At least your broker's fee would have been
exactly. Yeah.
Okay, bring back the Vikings.
My largest holding is now ASR. Which I thought was quite surprising. There must have been a little bit of growth there. That's now 7.39% of my portfolio. What I do like is my portfolio is starting to become a little bit more balanced. You remember at one time, all three was up there at about 16, 17% at maybe Agree Realty. So it's starting to come down into getting everything down to around the 5% range, which is more than manageable.
Really nice. And how do you feel about ASR being your biggest?
I'm not too concerned about that. I do like the company. They have nice dividend growth. I think a safe dividend, better managed than NN Group, who coincidentally are my largest dividend payer. So yeah, not too bad. And look, I bought a lot of them when they were trading cheap as well. So I'm bearing the fruits of that now with the share price.
Wow, yeah, 2023 was like a golden opportunity to go into the insurance stocks. I remember an N Group nearly touching a 10% yield, because of the Woekerpolis scare that was there.
Second place in my portfolio is Agree Realty, actually, and that's creeping up quickly. But I was buying them again, what I consider undervalued last year when they depressed, and they've done well over the last couple of months. British and American Tobacco was up there. I was not expecting that to be so high, but I have automatic drip turned on as well. So I've noticed my shares have now, I'll have decimal points. I was like wondering why, but
Yeah, I have the same. That's the nice thing about interactive brokers, right?
Yeah.
There, yeah.
And then Ahold Delhaize and Shell has dropped down to 5, which is surprising. That was top spot for a long time. So top holdings. Interestingly, I think I mentioned on the last podcast, I did complete the dividend safety based on our algorithm on all my stocks. What would you say my overall portfolio average safety is?
Like how much percentage is safe?
No, so I did.
Okay.
I did an average. So I did all
You,
of them.
you use the score. I don't know, 65.
66. You were banging nearly close. Yeah,
Okay.
which is good. And there's some companies there that are low, but I don't know if they're low because they are funds that don't have all the financial information that we'd have. So I have to manually go and do them. But I thought 66 was quite an average. My top 5 averages around 75, which is safe. So I'm happy with my top 5.
Oh, really good to hear.
Yeah.
Nice.
Yeah, so overall, I think I hit my goals, which was good. I have to sit down now and set my new goals for this year. Changes in my portfolio. I've got rid of Walgreens. I had to get rid of Beatrice. I didn't see the growth. And then BASF, I got rid of before they cut the dividend because I knew that was coming. And then there was some low conviction stocks. So overall, I'm quite happy with the performance. The share price is nice that it's now gone above the 100, but now I can forget about the share price and just focus on dividends. I just wanted to get that 100K out of the way. And
nice. And then this brings me still a little bit back to Shell, what you mentioned, that it went to 5% because Shell effectively didn't really accumulate in share price. Yeah, it started the year, I think, last year at 30.50 euros. Yeah, and it ended there as well around that place. But
yeah,
you know, the beauty of this is at the same time it bought back 6 or 8% of their share count.
Yeah.
So eventually this will push it up, and it continues to buy back a lot of shares. And for Shell to break historically the 30 euro level has always been hard. You know, if you go back in time, 2007, 2008, there was at 30. 2001 it was at touch 35. Then again in 2014 it was near 30. Then again in 2018 it was touching 30. And now it's already for a year around the 30, and it always struggles to break through this. Just it seems like a psychological barrier. And I'm not saying necessarily that this time is different, but if they continue to accumulate and buy back so many shares, at a certain moment, it needs to push it through it. It's just not sustainable unless they do a major acquisition again. But then still, you know, if it's cash flow accretive. So I'm really, you know, I don't care so much of the share price, but I'm very much wondering, like more from a popcorn point of view, will Shell, for instance, at a certain moment just drop all of that heavy weight of the psychology in the market and just push to the 40? I wouldn't like it because then the buybacks become less impactful. But oh my God, what a share cannibal is it at the moment?
Do you remember there was talks that they were, I don't know if they were looking, but there was rumors that they might move to the US, similar to what that would be for me the major catalyst. If they move to the US, I could see 50 euro a share easy if they move over there. I think that would be a catalyst. And who knows, with the stuff that's going on in the UK at the moment, that could be an option. Who knows?
But are they doing us a favor then? They are maybe doing people a favor that have stock options like management and such.
Yes.
But us as dividend growth investors, are they doing us a favor when we are in the accumulation phase? No, we get, as long as they at cheap, lower prices, let's say, can buy back shares, we increase our position. There's more dividend available to us. So I really wouldn't like this to happen from that point of view.
No, 100% agree with you. I think they'd have to reduce the share buybacks and maybe give out more special dividends, maybe, but I couldn't see them doing that. They'd probably stick with share buybacks. But
yeah, so it's probably management that has the biggest incentive, or the people that invest for price. But which investor invests for price in Shell? I mean, maybe when it was trading at €12, but today at €31, you don't invest for price.
no,
I can't imagine that.
no. I'm not a buyer at €31 either. But if it drops nearly 20, I'm a buyer.
Yeah, that's different. But then we're talking about valuation as such, right? So it must be only management that has an interest to get those big option.
And if you were management, you'd have to seriously consider that. You'd have if it was.
Yeah, but management should always act in at service of the shareholder.
Yeah,
not of themselves.
Yeah, but they might be a shareholder, so they're acting in service of themselves.
Fuck off. Anyway, hey, a great year. Really impressive to see that. And breaking the 100K was a big milestone for you. I remember that. And having a yield above 5% portfolio yield is also a big thing. And I think you really nicely took the opportunity, specifically in 2023 as well. And it's also good to see that you continue improving the quality of your portfolio. It's a theme in my end as well, right? And I think this is something that will never stop. I try to touch it as less as possible, but not every subsidiary in my portfolio is necessarily always a good actor.
Yeah, exactly. So. Nice one. So tell me about your quarter.
Yeah, my quarter went quite well. I will just share first with what I was all buying. I've been buying Evolution Gaming. No surprise, of course. So maybe that's good to know. Quarter four was really for me the quarter of the buy the dip opportunity. Let's call it like that.
Yeah.
I also bought, for instance, for that reason, L'Oreal. I bought Hershey. I bought Target. Remember people in the narrative at 120? Oh, Target is dead. Yeah. Come on, can't compete with Walmart and everything. Now that the share price is back at $135, the whole noise has gone away. But hey, I was able to acquire some dividends at a much better yield again. And just build up my position in Target. Also Johnson & Johnson. On the European side, I bought some additional Iberdrola. I like this company a lot for how it's operating. It was a bit on the expensive side, but that was a moment that I didn't know what to buy, and I felt like I need to dollar cost averaging. That's really where the discipline comes in to stick to the plan. And I bought some Bristol Myers. And some Hornbach, because also I think Hornbach gave a nice opportunity. Yeah. Last but not least, we just spoke a lot about Shell. I reinvested the dividends there. I'm doing this already for many years. And I know that already a lot of the shares that I kind of accumulate via dividend reinvesting are becoming quite substantial there. I think I even wrote about it in the annual report, a small item there. And that's really nice to see because you get such a nice feeling of compounding. Yeah. Now, what did I dispose of? Mostly tax harvesting, Bayer and Intel, but also BASF, because we know that the dividend is not going to be the same next year. So before it tanks in share price, I thought let's keep the cash on my end and try to reinvest it somewhere else. So I will be looking at a 5% plus yielder, hence also my Facebook post, because I was a bit crowdsourcing the ideas. Yeah. Just some ideas for what I may be investing in, because at a certain moment I'm all the time looking at ASR and an N group. These ones, I mean, insurance is having a heavy weight at the moment in my portfolio. So I'm not afraid to making it even heavier, but I feel like, okay, why not inspire myself a little bit with new stocks there. If you then look at the year-over-year growth in net dividend income in October, it was 100%, but that was after a dip the year before in October, because I at that time I sold the October payer. November is 66% more, December 7.7 7.7% more. But on average, my dividend income in the fourth quarter of last year grew by 33% compared to the year before. People will read in the annual report the details about the entire year. But I would say Q4 was really on the high end of this. And that has just to do with some new stocks that I bought that are paying more in October and November.
Yeah.
Portfolio yield stands at 3.7%, much lower than yours from that point of view. And I've got some technology stocks in there already for a decade that have really low yields. My portfolio grew only by 2.4%. That has mostly to do with quarter over quarter. That is mostly to do with the disposals I did for tax harvesting. I haven't reinvested that money yet, so otherwise it would have been a bit more. IT continues to be the largest sector in terms of value, 18%. My largest holding continues to be Shell with 6.4%. It was 6.18% last quarter, and they also pay the largest gross dividend for me.
Yeah.
Which means that with the dividend expense coverage ratio, when you think about the body, I'm now slightly above 70% here, which is really nice. Yeah, and the portfolio just continues to grow. I really hope to get to the 80%. So we introduced now these new levels on Facebook there with like the income start at 10% and then 25%. 50%, 80%, because that was something the moderators brought up as something like that would be so nice, because we had the retired early batch and that takes a long time for people to get there. So we now introduced those, we assigned them. So I believe people will need to accept. I'm not sure how that works, but then how is it? We should effectively get the community more interest in this to celebrate the milestones, because it's important, right? We need to celebrate our small wins. Yeah.
Yes.
Otherwise you're just doing it for 15, 17 years and you will never be able to pop up the champagne. So these milestones are very, very important. And yeah, I hope in 2025 to get through the 80% barrier. So let's cross fingers.
Yeah, I've no doubt you get it. When I look at looking at this, and I have another one open from this time last year, and you're like the Johnson and Johnson of of the dividend investing world. It's just like clockwork. Some nice growth, and I look back where you were when we started this podcast 4 or 5 years ago, and it's quite inspiring for me, and I know for others that are on the same trajectory, because I can see how it's progressed, and that's what I find most inspiring about this. But your portfolio yield is creeping up. It's creeping up. It's not as high as mine, but 3.7. It was 3.6 before that.
Yeah, no. Checking the first time when we did this, right? That must have been Q3 2020.
Yeah.
And because I track all the same in the sheet, at that moment in time, I had 27% coverage. But my portfolio yield was the same at that moment in time. So actually, I was then 3.69%. So it's effectively the same. Really interesting.
Yeah, that's interesting. Yeah, so it's fluctuating within the same range, but that was your aim, wasn't it? 3.25.
2.5. Yeah, on acquisition. Yeah. So then of course the yield. Well, yeah, no, it should relatively stay the same, but it all depends also on the organic growth of dividends there, right? It's a combination of, I would say. So I'm quite content with 3.7%. But there are some things I still need to consider. That's what I speak about in the annual report. Still need to consider for next year. I haven't made up my mind yet, so I haven't set my goals yet as such there. I will do that in the upcoming 2 weeks.
Yeah. I'm similar. So look backwards first, then set your goals. So I'm looking forward to your annual report. I've read some of it. I'm trying not to give anything away, so I won't say a whole lot. But is that going out today or tomorrow?
So today we are recording this on Saturday morning. Let's say this weekend. I need to do some prep still on the blog itself, because there are some things I need to configure. But yeah.
Yeah. Okay, perfect. So if it's not linked in the podcast, just go to EuropeanDGI.com and it should be there by the time this is released. Nice one. Nice quarter again. Always, as I said, inspirational to see the progress year over year. And I'm like a runner. I'm like behind you. You're the pacer out front, and I'm just trying to catch up. But it's nice. Listeners' questions, and we might start because I've noticed you bought Evolution, and you mentioned that this was like your buy the dip quarter. So I might start with a question about Evolution, and it's from Nick. He said, I would be interested to know your opinion on the current state of Evolution gaming. There seems to be so many headwinds. He opened the position a while back and is now down 25%.
Yeah, so I think foundationally this company is doing well. It may be that the growth has been slowing down a little bit from historically, but I think that's not what the market is pricing in. I think we just spoke about alcohol earlier today and tobacco stocks. I think that it's getting more and more the narrative of a gambling stock, and that is bad, and therefore a deep sin stock. We see that also in the comments often on Twitter or Facebook when Evolution is being brought up. Some people really have strong sentiment against such a company. I understand why, of course. So maybe due to its popularity as a growth stock, it also now grabbed the attention here. Also, a regulator like the UK brought it, had a strong impact on how market sentiment went, because they are at the moment reviewing the license that they awarded to them. So it may be that some additional risk is also priced in here. For me, it was overshooting, and I felt quite comfortable with it. And yeah, what for Nick is a 25% loss is for me an opportunity to buy the shares from him if he wants to hand them over, right? That's how the stock market works.
Yeah. I mean, they are trading at a nice yield, and I bought them as well at the start of the year, slightly after we had Wolf on the show. So I'm probably down similar amount, but I don't really look at the share price on that. I know fundamentally it's performing well. It is a sin stock. There's a lot of talk, as you said, around the UK. There's always seems to be bad press. For every good press it seems to get, there's at least 2 or 3 articles of bad press. And it is a gambling stock, but they provide the tools for other platforms to do the gambling. So I don't know why it gets as much heat as it does in terms of that. So I would have thought something like BATS.L, who have a gambling platform, might come under a little bit more heat.
But people have no issues buying VG properties, right?
Yeah, exactly. But look, it was a super high growth. I think that phase is starting to slow down. We can see that. So it's probably a new era for them, but definitely an opportunity. I just don't have as high conviction in them to double down on them like you do. I'm happy with my position. It's a relatively small position, and I'm happy, which is surprising because I'm a gambler at heart, but I just don't have the. So.
Yeah, let's put it in perspective. I'm now 8% down on the stock on average, and it is 1.6% of my portfolio. So if we talk about conviction, yeah, I have conviction there, but it's far from being a large position in my portfolio. It's a solid one, I would say.
Yeah. Nice. Just a guy has asked us to imagine we inherited 100,000. And now you just want to invest it. Is it going to be in one stock, many stocks, or what distribution over a period of time?
Yeah, well, this is a question we get from time to time, right? The answer is the same. Dollar cost average. I would at least do a year, so probably 8K each month maximum. And just buy it in some stocks that really provide a solid foundation, but not every of your wish list will be available at the moment of time. You have some cash to deploy, so just watch out that you don't buy yield traps.
Yeah, but you know, if it was an inheritance that you were not expecting, and it's money you did not expect to get, maybe you could pick one of your higher conviction that have a low dividend yield that you would never have bought before, because essentially it's
400K.
it's free money. Maybe not 100K, like, but you could
When your portfolio is 60K, you buy for 100K.
ASML or something.
It says who that didn't buy enough evolution.
I know.
Hallelujah.
I know. No, personally myself, I'd be the same. I'm too risk adverse to throw 100K into one stock. It would be over time, and it would be just added to my monthly purchases whenever I buy.
Yeah, I would do the same. Not financial advice, just a guy.
No,
with full disclosure.
No, but I might add so many companies that I feel like have a lower yield and higher growth that I typically wouldn't add now. I might add that with that money every month. Chasing high yield. Rodrigo, does it make sense to invest in small companies, less than 2 billion market cap, for example?
Yeah, why not?
From a dividend perspective.
Yeah, why not? They have, at least from a market capitalization point of view, potentially a lot ahead of them compared to maybe others that are already richly valued. More often they are also not so well known, so the multiples are not necessarily so high. If they are not in the S&P 500, then it's also not automatically pulled into all the indexes. So if you find a company that where you really like the business model and it has a safe dividend, then why not? Yeah, it's actually, you might benefit actually from the compounding much more there because it's not such a popular stock that is in all the indexes.
Yeah. It's probably a market, if you knew it well, there's a lot of opportunities.
Yeah. So, and I think you more quicker at those kind of level of companies, you get back to your home market. Yeah, because when we are talking about the blue chips stocks that, I don't know, 50, 100 billion valuation, we all know them. Those are global companies. But for instance, like DEFAMA, let's take that as an example. Yeah, few million, well, more than a few millions, but let's say 100, 200 million, whatever it may be. Yeah, that of course requires a total different way of looking at it. And then you really want to have a feeling for their assets. So in that case, if you're in Germany, just stop by in one of their objects and look at the building, go do the shopping, and then reflect on what you've just experienced. And if this is indeed a good quality building, do you see it's busy there? And then that's how you check it. Then you're much more into the Peter Lynch philosophy of investing. Then
invest too much,
Yeah.
Dividend Opportunities has asked us, do we prefer to have an 8% dividend yield with a 2% compounded annual growth rate, or a 2% dividend yield with an 8% compounded annual growth rate?
I would go for the dividend first.
So the one component that's missing for me is time. What time scale are we talking about?
But I don't feel like waiting 20 years for this. Or 30 years. So I'll take the 8% now because I prefer the income. And I
would take 8%. But if you were to put a time component, then he said minimum of 50 years, you would probably.
Then I would go probably for the other one. But if you don't take tax into the equation, and you would reinvest the dividends, you would end up anyway still the same. So
damn tax. Alexandros, what are your first buys this year?
I didn't buy anything yet.
I have bought Iberdrola, and I bought one of the funds. I think it was Aberdeen Income Trust. So that's actually my December, but I didn't get to invest in until this year. So they were my first buys yesterday. Not yesterday, 2 days ago. Hussein, if today you would have the chance to go back to university and shape your career, would you choose to be a professional who works in an investment company, or prefer the same careers as you do now with investments as a side hustle?
Yeah, I don't know about you, but I'm not so much the person that regrets the choices that I made in life. So I'm just really happy with how it went. And therefore, knowing what I know today, I will probably choose the same path, because I don't know if another path would have brought me to the same level of happiness that I have today. So this is like, we have a Dutch proverb, I believe it's like, better having one bird in the hand than 10 in the sky.
Yes.
Yeah.
Two in the bush, we say in Ireland.
So that's why I find it hard to answer this question.
Yeah, I don't think I would go back and be a professional in an investment company. I like what I do. I think I'm suited to being an engineer. It suits my personality. I enjoy my work. So I feel if I was to work in an investment company, maybe my investing would be different. My philosophy would be different. My attitude might be different towards it.
But imagine being surrounded by all those bankers and everything being gobbled up into this system.
Yeah.
That would be horrible.
You're just another cog in the wheel. Yeah, I think I prefer it this way. It's more of a passion. I mean,
Yeah.
I don't come on this podcast because I have to. It's because I want to.
Yeah.
Whereas when you're working somewhere, that feeling might fade quite quickly. So
If anything, I would have loved to work in let's say, in an investment firm like Berkshire Hathaway or Fundsmith, yeah, from Terry Smith, like where people have a long-term investment horizon, really do their best to analyze companies, not just quote the headlines from Bloomberg Terminal.
yeah,
They're really where they do proper due diligence, maybe even the Hindenburg group that does all these research about companies and goes them sure. I would probably more look into that because that would nurture my analytical mind much more.
yeah. I listened to a podcast. It's an Irish podcast recently. It's about they talk to like successful business owners within Ireland and talk about their histories and how they built up, right? And I can't remember the name of the podcast it's gone from, but there's 2 episodes, separate episodes, and it just so happened that they both started as investment bankers or investment companies. Now they went on into different careers and did different things, but the picture that they gave me talking about that time is actually not so pretty. if I'm honest, quite like you're in a ring of people. You're like cattle. You have to go out and get your own customers, and it's honestly, I feel like you're more like a salesperson.
Yeah.
I feel like if I was in that role, I would not have the same passion I would have.
No. That's why I said, knowing the happiness that I have today, I would not exchange that for something else.
Exactly. Brian, do you use the new year to take stock of your strategy and set out objectives or goals for the new year? If so, do you usually stick to the plan?
Yes, and yes, and yes. But it's sometimes hard. For instance, sometimes like June, and then I really think about myself. Oh, I haven't looked at my goals for 3 months or so. Let me check. Okay, hey, I'm on track. Or I'm starting to drift. Let's go back again. Yeah. So it's not easy to always stick to the plan, but it's something that I really put a lot of effort behind.
Yeah, I'm similar. I always set the plan. I have a presentation that I add. I start in 23, of 24, after that 25 now, and I try and stick to it. I give myself clear guidelines. Maybe not always 100%, but if I stuck to it 90%, I would be happy.
Yeah.
A second part of that question is from Philippe, and he's asking, do we have any New Year's resolutions, any special related to investing?
No, not particularly. I just want it to be a good year again.
Yeah, I have some goals, but especially related to investing. No, it's just grow my dividend income.
Yeah, it's as simple as it can be, right?
yeah, it's so easy. It's great. It takes me 30 seconds to think about it.
Yeah.
Yes. K10 has asked us, what are your thoughts on this year's growth in European companies' earnings and the overall economic prospects for the Eurozone? Will Germany's potential recession and the auto industry problems cause a contagion in the rest of Europe? So are we looking at the Eurozone being the sick old man?
I look at it a little bit different. I think companies with exposure to the European market may see some stagnation here and there, specifically if you are a company that is part of the supply chain of the car manufacturing industry. Yeah, that's how I look at it. Because the same applies, I don't know, to good old PepsiCo or something like that. They have a lot of sales from Europe. I remember actually, was it LVMH or one of those companies? They actually had Europe as one of the best performing geographical areas. Yeah. So I really think that it depends on the company, and I would consider really looking at it from that angle. Which which companies have exposure to certain markets in Europe that are very fragile or under stress. And I think the car manufacturing industry, automotive, is a really good example. I really feel like they have lost the boat in terms of competition. They are just not flexible enough. Too high costs, and specifically in Germany with the labor unions, you really lose flexibility. I mean, I don't know about you, but have you gone to the dealer for Volkswagen, for instance? They still look the same like 10 years ago. Yeah, most of them.
Yeah.
So I really think they lost some mojo there. And yeah, and I think those companies, and those could also be American companies that are part of those supply chains, I think they may have a hard time. What I'm more concerned about is this mindset that we have in Europe, that is where we don't reward risk takers, people that are innovative. We tie them up to a pole and bash them as they are. That's it. That they are bad. You know, they're bad. They're poison to society. Yeah, we tax the hell out of them. That is at least what we want. Yeah, because everyone remembers the Panama Papers as such as well. And of course, we kill small businesses with regulations. Yeah, I mean, even ASML last year this year did a strong warning to the Netherlands, saying like, hey, if you want us to stay here, you really need to improve the tax and investment climate here. Yeah. So make of it whatever you think. When ASML says that, fact is, competition from that point of view is not fair because you're competing with America and China that have a total different approach to this. So as Europeans, we cannot. And that's my philosophy here. Is we cannot just think that we will lead the world like that by our value system of capital markets. No, we don't.
Yeah.
So then either you play along and try to influence from without, or you do what we are probably doing mostly now. We just regulate the hell out of it, and yeah, we make it less attractive to do business with us, and our products will start lagging behind in many aspects, and we'll pay the price for that as a society. But society will probably play the victim loop and blame others.
Yeah.
This is where I end, because otherwise I go into politics, but this is kind of the sentiment I feel around this question.
RMS. Have you ever looked at Norwegian energy company Equinor?
Yes, really nice one.
This company.
It's a good company, one of the good oil and gas majors in the world, I would say. And I've got already enough Shell and others, but it would be hard for me to choose, for instance, between Equinor and Total Energies.
Question from Dionys. What's your thoughts on Novo Nordisk? So, do you know what? I know you've done a deep dive in that company, but I haven't really looked at them in a whole lot of detail, if I'm honest. So look, I don't know. I know, look, they're a decent company, but they're not on my radar.
So fair value, I mean, I leave that to our premium subscribers, right? But the Novo Nordisk in itself, of course, they hit the jackpot with GLP-1, and they had quite a setback the other day. They're still leading in the space. There's competition because everyone wants a share of this pie. I still see Novo Nordisk leading this for years because of the first movers advantage. The question is, was it priced for perfection and for a monopolistic a share of the pie, or not? I think it was rather priced for that, and I think the reality is kicking in with investors that there are more companies in this space, and that Novo Nordisk may have a first movers advantage, but not a winner takes all opportunity. So, and I think that's for what it's repricing itself for.
Eric has asked us about realty income. Do you think that their portfolio of properties is scaring investors away?
Maybe we know they have a lot of Walgreens.
Yeah. I think it's a mix of the properties, but also they're starting to go outside our circle of competence. We
And
know,
that's mostly it. That's
Yeah.
what we talk about. But because when you think about that outside the circle, what they were doing, well, they bought some great assets in Decathlon. I mean, look at Decathlon.
Yeah.
I do think like if Decathlon is not there anymore, I don't see another company easily going into this. So it's a very much tied in with that business model. So people that don't know Decathlon, that are from America, it's literally those big hangars painted totally blue in the colors of Decathlon. And I think you could maybe turn it into a logistics center or something like that, or a distribution center. But this concept of such kinds of stores, maybe building markets still, but other than that, I don't really know what company would want such a building, what's such kind of a property. So I think there's a strong tie into that.
Yeah, and obviously that comes risk.
Yeah.
Lots of risk. Mikhail has said that I mentioned in one of the last episodes about JGGI, which is JP Morgan Growth Income Fund. And he's asking, could this be a good SCHD alternative for EU investors? I don't know, have you ever looked at the trust? One thing I will say is they target a 4% yield on NAV the previous year. So you're not going to get much more dividend than that. So you're kind of capped in terms of where the growth is. But one of the big concerns I have with JGGI going into this year is that they are heavily reliant on the Mag 7, particularly. And they didn't hold Apple for a couple of years. They bought back into Apple midway through last year as well. So they're heavily reliant on that. So a lot of their performance this year is going to come from those companies. Now, what you think of that, who knows whether they'll continue on. If they continue on the way they have been the last couple of years, no problem. But if they stutter, if they struggle, you'll start to see some of that trickle down into funds like this. So it's just something to be aware of. But look, you're right. The yield, 4% yield is good. They have a good dividend growth record. In fairness, they've been growing their NAV quite well. And their past performance have been pretty good. But just be aware that there's other funds out there that you can maybe get with a higher yield and less exposure to those sectors. So depending on how you feel about the Mag 7, depends on how good you feel about that fund. But I still think it's a good fund. I'm still adding to it, just so you know. But I just want to be aware that I'm not adding to it without knowing that there's risks of lower returns this year. And then finally, Yoram has asked us about our thoughts on Reckitt Benckinshaw Group. Seems to be an undervalued defensive consumer staples company.
Yeah, I don't really look at Reckitt anymore. It's just not a company that I really feel like having in my portfolio. So I can't give anything meaningful about it anymore.
Yeah. I looked at them last year at some point. I wasn't impressed. So I'm staying away. We've got hundreds and hundreds of companies. We don't have to stick to some based on how they performed in the past. So I prefer to look somewhere else. Perfect. Thanks a million again for all our questions. Thanks to all our listeners. If you haven't already, subscribe to us on our Facebook, like this on Spotify, Apple, wherever. Leave a review if you can. Start the new year right for us. It'll really help the algorithm. And hopefully we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.